Hey Crypto Nation, today we're talking about a key concept that affects the price you pay or receive when swapping assets, the exchange spread. Understanding spreads can help you make more informed decisions when trading. Let's break it down. What is an exchange spread? Well, in simple terms, the spread is the difference between the bid price, what buyers are willing to pay, and the ask price, which is what sellers are asking for. For example, if buyers are bidding $99 for Bitcoin and sellers are asking $101, the spread would be $2. Now, this $2 difference typically represents the cost of facilitating trade. In centralized exchanges, this may go to market makers, while in swaps, like those in Exodus, the spread reflects the exchange rate provided by the third-party API providers serving the swap. If you're wondering why the spreads vary, well, there are a few influences. Spreads are affected by liquidity, volatility, and overall market conditions. In highly liquid markets with many buyers and sellers, spreads are narrower due to the strong competition, while low liquidity markets see wider spreads as fewer participants lead to a bigger gap in the prices that buyers are willing to pay and sellers are willing to accept. Now, during high volatility, where prices fluctuate rapidly, spreads can also widen to account for increased risk, whereas stable, low volatility markets have tighter spreads. Additionally, market conditions like high demand or low activity can also impact spreads, with heightened activity often widening spreads and balanced conditions narrowing them. Now, in the case of Exodus, spreads are built into the rates you see in the app and shown on the swap screen. When you swap one cryptocurrency for another, the spread is part of the price difference between the asset you're sending and the asset you want to receive. It's also important to remember that transaction fees, which you'll also see quoted before making your swap in Exodus, are not included in the spread. These fees are set by the blockchain network and vary based on demand and congestion. Transaction fees are not collected by Exodus, but go directly to the blockchain network. Now, to minimize the impact of spreads when exchanging, it's best to trade during periods of higher liquidity, such as when global markets overlap, as more active participants keep spreads narrower. Avoid trading during high volatility periods, as spreads widen and transaction fees often increase, making trades more expensive. Now, as a rule, before hitting that swap button, it's always important to factor in both the spread and transaction fees to accurately assess the total cost of trading. And there you have it, exchange spreads explained. Whether swapping crypto in Exodus or trading on an exchange, understanding spreads can help you make smarter trading decisions. Thanks for watching, everybody. And if you'd like to learn more about trading or crypto concepts, click any of these videos to keep watching.